Hello people, welcome to our second film on chart analysis. You'll find the material discussed in today's film much easier to digest if you run through it using our charting software Rumus. Rumus can be downloaded for free from our website at www.fxclub.com. In Chart Analysis 1, we looked at support, resistance, trend lines, channel lines, and we explored what a trend really is. We described technical analysis as a science, and we looked at the theory behind it. In this film, we're going to view chart analysis as a subjective skill. We're going to focus on the art in charting. I'm going to take you inside the trader's chart room and look at a selection of chart patterns that crop up time after time. Generations of traders have used these patterns to identify future price movement. These patterns can help you make money. Just a word from the wise though, never underestimate the market. Countless people have spent their lives trying to find a surefire pattern that allows them to predict the market with 100% accuracy. Only very few succeeded, and those that did have only been right for a short period of time, and then the mood of the market moved on, leaving their elaborate systems useless. The fact is though, that the patterns we're going to be looking at today are accepted as the most reliable patterns, and many traders act on their signals. In some ways, what we're doing is exploiting a self-fulfilling prophecy. What we need to do is see what the other players are seeing and learn to read these patterns in order to take the next step. Make sure that you work with patterns that are easy to spot. Just remember that the more traders that can see the pattern, the more predictive that pattern will be. These patterns are traditionally split into two camps: the continuation patterns, which signal that the current trend is going to continue, and the reversal patterns, which signal that the current trend is about to reverse. Let's start off by looking at some signs of reversal. This simple pattern is known as a reversal day. You can find it either at the top or the bottom of the market. Now, it stands to reason that the basic requirement of any reversal pattern is a prior trend. Therefore, the first thing to remember is that each and every reversal pattern needs an uptrend or a downtrend to reverse. This trend can be a major, an intermediate, or a minor trend. And all we need is a trend of some degree. The reversal day follows a typical pattern. On a bull market, it is preceded by a sharp price rise, and the pivotal day sees a bar with the highest maximum and with a closing price lower than the low of the previous bar. So the bar of the reversal completely covers the bar of the preceding day, as you can see here. This pattern crops up pretty frequently on charts, most usually on minor trends. Why minor trends in particular? Simply because sudden price changes are short-term in character. So what should we do if we spot a reversal day? First of all, we should fix our profit. Close any position you have on the preceding trend. It's better to be safe than sorry. And at the bottom of the market, the advice stays the same. Cover yourself. Fix your profit. Sometimes the reversal takes place over 2 days.
and we call this a 2-day reversal.
On an uptrend, prices on the day are rising and achieve a new maximum. Prices close at a point very near to the day's high. The next day sees price closing at the low of the day before, or even lower than it. One point to note is that the wider the price range over the 2 days, the more power the reversal has.
The significance of the reversal, whether it's a 1-day or a 2-day, relies heavily on where and when it occurred on the market. You've got to look at the bigger picture.
If the market has risen or fallen sharply without any intermediate corrections, or has neared long-established resistance or support levels, then the reversal signal deserves your attention. Sometimes reversals happen as part of a larger and more significant chart pattern. We shall explore these larger chart patterns further.
When this happens, the reversal tips us the wink that a more significant pattern is on its way.
You know, pretty often, a reversal of a short-term trend happens near a long-term support or resistance trend line. Although we call these patterns 1-day or 2-day reversals, the pattern can be found on charts of any time period. Please bear in mind that the longer the time period, the more significant the reversal.
I'm not suggesting that you trade only on monthly charts. What I'm saying is, gauge the value of this pattern with the longer term trend in mind.
And if you're looking at a monthly chart and you happen to notice a day reversal pattern on it, then it can give you an idea of the direction of the trend for the next 3 or 4 months or so.
And that is going to help you in your daily and intraday work. The next pattern from the chart room that I'd like to take a look at is based on 3 trend lines.
It's called the fan principle reversal, and it's an alternative way of using trend lines. You know how when there's a downtrend line breakout, price often falls back a little, retesting the old trend line, which is now a support line, and price fails to break through it. So what you do here is plot a new resistance line, which price breaks through to, and then falls back, giving us a new support. You plot a third resistance line, and when price breaks out of this, it usually signals the beginning of a new uptrend. At the top of the market, the breakout of the third fan line signals the beginning of a downtrend.
It comes as no surprise that this is called the fan reversal, because the 3 trend lines look like an open fan.
The main thing to remember is that breakout on the third line is a strong signal of trend reversal.
Sticking with the theme of trend lines, here's a technique which combines support and resistance lines with correction levels. What you've got here are your speed lines.
Cast your minds back to our bit on correction levels in the last film. Do you remember? To plot correction levels, we draw a perpendicular from the trend minimum to the level of the beginning of the movement. We measure off 3 points on this line at 0.382, 0.5 and 0.618. We then plot lines from the beginning of the movement through the correction points. These lines are sometimes known as projected trend lines because before the correction occurs, the lines hang in the air, but once the correction begins, these lines delineate levels of support and resistance. Play around with it on Rumus and you'll see. Here, they map out new lines of support and resistance on a correction of an 8-month downtrend of the euro in 2005.
You can use speed lines on any time horizon. Just remember, the longer the time period, the stronger the punch and the more potent the reversal.
You can plot speed lines without going to the trouble of dropping perpendiculars and the like with Rumus, Forex Club's charting software. All you do is identify the trend line on the chart in pink, drag and drop FIBO-FAN to the trend line, and Rumus will do the rest. Here's a fan I plotted on the Aussie way back in 2002. The lines of the fan continue to give useful information to this day.
These lines have a wealth of applications which we'll explore in our film on wave analysis. This pattern is called head and shoulders. It's not to be confused with a medicated shampoo, I might add.
The pattern is a great favourite with traders and was identified way before the appearance of the shampoo. Why they called it head and shoulders is obvious. The large peak in the middle is the head, while the two flanking peaks are the shoulders.
It's not only a very important pattern in its own right, it's also the key to the other reversal patterns. If you can work well with head and shoulders, you'll easily cope with the rest.
In fact, most of the other reversal patterns are mere variations of head and shoulders and therefore will not need an in-depth explanation. The reversal patterns reflect the play of forces that produce trends on the market. Remember the three groups of traders in the story in Chart Analysis 1?
In our first film on chart analysis, we saw how useful it was to plot lines on our charts. Lines like support and resistance, channel lines and trend lines. We'll continue with this now that we're dealing with patterns.
Learning to plot these lines will significantly improve the returns on our trading. Let's consider what's happening on the market while head and shoulders is forming. We start off with an existing uptrend, that is consistently rising maximums and minimums. Price then decelerates and falters, just as we saw with the fan reversal, and the trend flattens. At this moment, the forces of supply and demand are in balance. At the end of this phase, price breaks through the flatter support and a new trend, a downtrend, begins. This support line is known as the neckline. Sometimes the neckline can be plotted immediately after the left shoulder has taken shape, but usually we need to see the head before we can plot the neckline with confidence. More often than not, the right shoulder is similar in appearance to the left.
This repetition of shape and patterns is the key to chart analysis. It enables us to use price history to understand its likely future.
The formation of the head clearly demonstrates the deceleration of price. As the right shoulder is a smaller peak than the head, it can be seen as a final confirmation of the reversal. But be warned, nothing is 100% guaranteed, and price could rebound off the aptly named support, break through the resistance and reach for the skies.
Well, maybe the movement was caused by a change in the economic climate and the fundamentals were making themselves felt. Whatever, At least the support line lived up to its name.
So, to recap, we've covered 3 essential elements of chart patterns. 1. The presence of a prior trend. 2. A recognizable pattern. And 3. A trigger line. That's what I call lines like the neckline. Now, a 4th defining feature is a breakout of this trigger line. Only on breakout can we say that continuation or reversal has been confirmed.
The neckline of Head and Shoulders is either horizontal or it slightly slants upwards. Let's take a look at what happens on breakout.
The neckline is like any other trend line, so we've seen it all before. There's an almost obligatory return to the broken support from below, as if retesting its strength, and then price heads south. And the price target? It's the height of the head. Chart it like this. Drop a perpendicular from the maximum on the head down to the neckline. Then project the same distance down from the neckline.
You measure the potency of any pattern by its size.
Basically, this is a situation where size does matter. The height of the pattern shows us how volatile price is, while time is measured on the horizontal, giving the pattern width. So people, the bigger the better. The larger the pattern, the greater the promise.
We should also check the significance of the reversal pattern by comparing the time it took to form with the lifespan of the trend it formed on.
Given that price trends in 3 directions, I use the rule of 3s to measure significance, so T1 should be at least a third of T2. A general consensus of opinion amongst technical writers has it that Head and Shoulders should be between 1/4 to 1/2 of the age of the prior trend. What if the time the pattern took to form is less, say around 10%? Sure, the dynamics of the pattern still hold, but the kickback from the pattern is going to be short-lived and the move relatively puny. What we've got here is a reversal of a lower degree. In our time frame, a mere correction.
The final essential element in the chartist story is volume.
Volume is traditionally the measurement of trading activity during a time period, whether it's a minute, an hour, a day or a month. It's displayed at the bottom of the chart as a series of vertical lines. What does volume tell us as Head and Shoulders is being formed? At the max of the left shoulder, high volume tells us that enthusiasm is up. When price forms the maximum of the head, we can see that enthusiasm is waning. Volume has dropped, and by the time we get to the right shoulder, volume is tiny. Once the neckline is broken, volume shoots up to its previous highs as enthusiasm mounts for the beginning of the new trend. When price retests the neckline from below, volume drops dramatically. At the bottom of the market we can find a similar pattern we call inverse Head and Shoulders. Here the neckline is either horizontal or slightly sloping down.
And what should the trader do with inverse head and shoulders? We set the price target in the same way.
We've already touched on the symmetrical nature of head and shoulders. Even a complex left shoulder has a faithful follower in the right. This feature allows skilled speculators to anticipate price movement. Not everybody waits for the breakout on the neckline. They plot a resistance line here, open a position and place a stop loss below the support on the right shoulder. When and if a breakout occurs, they're in a safer and more favourable position than their peers.
I'd just like to say a few more words about volume on the forex market.
On the futures and equities market, volume is a precise record of trades. When the forex market was opened up, business information services like Dow Jones were ready to offer their services, but they ran up against an obstacle. The majority of banks agreed to release the prices of their transactions, many of which, by the way, take place on the over-the-counter or non-exchange market, but they categorically refuse to release trading volumes.
They mind their own business. After all, they are banks, and traders, long used to using an analysis of volume on other markets, were stymied.
After a few years of research, it was discovered that the number of changes in price, the ticks, in one day reflects actual trading volume quite adequately, so the columns under your charts are only a record of the number of price changes, the tick volume, for that time interval. Volume is a very sound indicator when you are working with daily charts and longer. But please be careful when you're working on intraday charts, because the periods that mark the overlap, the opening and closing of the major exchanges around the world, will usually carry a disproportionately high volume. Generally speaking, volume helps determine the health of the existing trend. A healthy uptrend should have a higher volume on the upward movements of the trend and a lower volume on the downward corrections, and vice versa. I think of it as a vote of confidence in the trend's direction. The fact is that, although it is universally acknowledged as a very important factor in technical analysis, most of us use volume very primitively.
It's a bit like only using your computer to play games.
But technical analysis is still a relatively young discipline, and I hope that future years will see a better exploitation of volume.
But let's get back to our chart room. The next group of patterns is called multiple tops and bottoms.
It's a smooth transition from head and shoulders to triple top. Basically, all you need to do is level the three peaks and to plot the neckline. This time it's strictly horizontal. And voila!
Cast your minds back to the trading range. Remember how we described how trends are made up of these bricks?
We can regard the range or flat as a basic element of price charts. Now, double, triple, in fact any multiple top pattern only occurs when price has met a good resistance level, formed a range and could not break through the resistance, but broke out on the support instead. This breakout completes the pattern. Whether it's double, triple or four tops merely depends on how many times price bangs its head on the ceiling. Price target is H. In a second scenario, price hits a strong support level at the bottom of the market, and we get similar patterns, double bottom, triple bottom and so on. Target is the same as the tops.
Double tops and bottoms are the most widespread of the reversal patterns. If you can tell me why, drop me a line. If I agree with you, I'll send you a prize. Next in the chart room is the failure swing, another reversal pattern.
It's another head and shoulders mutant, only the left shoulder is missing. You could also see it as a variety of double top with a lowered second top. There you go. The reversal usually happens after a breakout on the trend line or the support, often with some retesting after. So you need to keep an eye on both lines. At the bottom of the market you need to monitor the trend line and the resistance line. A good tip here is to monitor a potential failure swing using the indicator RSI. We discussed this indicator in our film The Essential Indicators. That's the fourth film in our series. What you should look out for is a divergence between the indicator and the price. Here, divergence is noted as price eventually forms a double top with RSI charting a failure swing. Basically, a breakout of RSI is very often a strong signal for a breakout of the trigger line by price.
Strong movements often begin with a failure swing, so in spite of the name, if you get in the swing, it could well turn out to be a very successful move.
All you've got to do is get with the swing.
The next chart from our chart room is the broadening formation.
You can picture it as a head and shoulders with a raised right shoulder. There you go. So what you've got is three rising peaks along an either horizontal or nearly horizontal but slanting up support line. Volume decreases with each peak. The pattern is completed by a breakout on the support.
With these head and shoulders variations, you can see that the names and the shapes of the patterns vary, but the principles, such as price target after breakout, remain stable.
At the bottom of the market, the situation, as usual, would be reversed, with the trigger line being a resistance and the breakout of which leading to a reversal upwards.
All you have to do is anticipate the completion of the pattern, plot your support or resistance lines, and, very important this, don't forget to place your orders.
Everyone here at Forex Club would encourage you to read up on trading as much as you possibly can. But I'd like to warn you at this point that the majority of books on technical analysis use the terms broadening formation and expanding triangle as interchangeable. This can be confusing because there is a pattern known as the expanding diagonal triangle in wave analysis, and although the patterns look the same with two diverging trend lines, the dynamics behind the patterns are really quite different. We'll be taking a closer look at Elliott's expanding diagonal triangle in our film on wave analysis.
You'll often find broadening formations on intraday charts, but take care when you're identifying it. It's difficult to spot and difficult to work with. Many traders have slipped up with it. Let's move on from the reversal patterns. The next item from the chart room is the wedge. Wedges are very interesting and can be both reversal and continuation patterns depending on what type of wedge they are and whether they appear on an uptrend or a downtrend.
Wedges are formed by two converging trend lines. The distinguishing feature of the wedge is a definite slant. There are two types of wedges: rising wedges and falling wedges. If the slant of the wedge is in the same direction as that of the trend, it's a reversal signal. So a falling wedge on a downtrend is a reversal signal, and breakout will most likely take place upside. A falling wedge on an uptrend is a continuation signal, so once again, prepare for a probable upside breakout. The price target after breakout is at least the height of the wedge. However, as a rule, price reaches the first correction level, especially if it comes at the end of a long-lasting trend.
The wedge should be classified as an intermediate trend pattern.
As you'll recall, Dow defined an intermediate trend as lasting from 3 weeks to 3 months. If your main trend is no bigger than 1 to 3 months, the wedges that are formed over 120 to 360 hours, that is 3 to 5 days, are of great interest to you.
Once they've learnt about the profit potential of the wedge, many novice traders start looking for it. And they find wedges all over the place. The thing is though, that they're often disappointed by what they've found. We could call this the result of wishful thinking.
We need to understand wave theory in some depth before we can identify wedges with certainty.
Wedges are explored as a type of diagonal triangle in wave analysis, and in our film on waves I'll do my best to clear things up once and for all. One of the most significant groups of continuation patterns are the triangles. There are 3 main types of continuation triangle: symmetrical, ascending and descending.
Triangles are usually described as continuation patterns because they signal that the previous trend will continue. However, if we examine what forces form them, we might choose to be less dogmatic.
Triangles map out a period of uncertainty on the market.
This uncertainty encourages investment companies and fund managers to take money out of the said market, in our case forex.
Here we are considering time periods of a day at the very least, as these longer periods are of importance to the bigger players. If the longer term developments on a given market are not clear, bigger speculators leave that market by squaring their positions.
This happens over a period of time and results in a triangle pattern on the chart. Of course, there are some participants who simply can't get out because of their business. On forex, these are the banks. They're not here to play. They're simply doing their job, oiling the wheels of commerce.
Those who have left the market are sitting on the fence, waiting for some clear signals to act on.
The gradual reduction in volume leads to a diminishing fluctuation in price. The banks, who are the majority now on the market, are not actively speculating. They're just maintaining a steady rate. All this leads to a rougher quality in the speed of our 2 converging trend lines, our support and resistance.
Now I've mentioned lines. Remember, we need at least 2 points to draw a trend line.
So, as a triangle is two converging trend lines, we need 4 points. 2 points for the lower line, 1 and 3, and 2 for the upper, 2 and 4. So the minimum number of movements inside the triangle is equal to 3. This holds for any triangle you chart of whichever type.
Let's take a closer look at the symmetrical triangle.
The two trend lines cross in the future, and the point where they cross is called the apex. If we say that the distance from point 1 to the apex is equal to t, then breakout should occur between a half a t and 3/4 of a t. The zone located beyond 3/4 t is an area I call the no zone, because here the trend lines lose their force. They peter out, and any breakout is likely to be insignificant.
Why should our trend lines lose their potency?
As we said before, some participants are compelled to stay on the market. These participants endeavour to maintain as steady a rate as possible, and if this situation lasts for a reasonably long time, other patterns such as a trading range may well develop.
Mind you, nothing lasts forever, and the clouds of uncertainty will clear in time, revealing a definite direction in price.
The direction of the breakout depends on the current state of economic conditions and expectations on the market. Research suggests that 75% of symmetrical triangles are continuation patterns, leaving the other 25% to prove themselves as reversals.
What should the trader be doing while a triangle is forming?
Well, you can monitor for a new trend using an indicator like stochastic, as covered in our film The Essential Indicators. Or you can check the validity of the breakout using support and resistance trend or speed lines. I'd advise against second-guessing the breakout. Wait for the breakout to occur and then check its validity before opening. Take price target after breakout as the height of the triangle, which is the highest high and the lowest low of the triangle. But remember, once you've passed into the no zone, the power of the triangle is spent. Set the nearest levels of support and resistance and monitor the range.
The triangles we've been looking at were formed on daily charts or longer intervals. However, you'll find triangles on hourly and shorter charts. The rules and guidelines hold true for these charts too.
Triangles for shorter time intervals take less time to form, and of course price fluctuation is proportionally less. The bigger fish on the market have already opened their positions, or maybe they've moved on to pastures new. These minor ripples are of no interest to them.
But there are smaller fish in the sea.
Everything is relative. If you're working with a deposit of $1,000, then a trader who's managing 100,000 will seem like a giant. And from his point of view, someone with a fund of $10 million will seem like a colossus. In short-term periods of uncertainty, even the banks, the market makers, can significantly reduce their trading volume. You'll find both giants and dwarfs working on different time periods. But a symmetrical triangle is a symmetrical triangle, and it obeys the rules that I've outlined regardless of the time period you find it on, and furthermore, regardless of what market you find it on.
Your task is to spot your patterns, plot the lines, and place your orders. Pure and simple. The other two triangles in the chart room are both right-angled triangles, ascending and descending.
Let's start with the ascending triangle. It's a close relative of the symmetrical triangle. The essential difference here is that instead of a resistance line, we have a resistance level. This gives us a horizontal upper line. This pattern shows us that the bulls are gaining dominance and are confident that prices will rise further. They are usually right, as an upside breakout is favoured, and the ascending triangle is known as a bullish pattern because of this. But be warned, however, it's not a sure thing.
Only time will tell. Whatever will be, will be. Please remember that the no zone remains in force.
A descending triangle is a symmetrical triangle with a support level instead of a support line. A downside breakout is likely, so a descending triangle is seen as a bearish pattern.
In fact, our exploration of triangles brings us back to the chartist central themes of support, resistance and trend lines. The only extra consideration is the no zone. Let's look at some brief consolidation patterns which are amongst the most reliable of the continuation signals.
First off, we have the flag. What you get here is a sharp increase in price. This forms the flagpole. Then, as often after a sharp rise, there's a pause in the market, a short, choppy consolidation which takes the form of a slightly dipping channel. That's it. You can see why it's called a flag. After the pause, price continues its rise. People say that the flag flies at half mast, so the price target on breakout is equal to the rise from the bottom of the flag post. The channel forming the flag is a precise resistance line, therefore place your stop loss just below it. Let's fly the flag. The correction can also take the form of a small symmetrical triangle. When this happens, we call it a pennant.
Opening positions and setting price targets remain the same.
Flags obey the wedge rule that when the flag slants in the direction of the prior trend, then it's a reversal signal. Although these patterns were first identified when traders could only make money on price rises, flags and pennants work just as well on a downtrend, their reversal reflecting the symmetry of the market.
The next chart room favourite is usually referred to as a rectangle, for obvious reasons.
Cast your mind back to multiple tops and bottoms. Picture a double top being formed. You're waiting for price to reverse through the support level, but to your surprise, price breaks out through the resistance level on the third attempt and then continues its rise. This is the rectangle. You could call it a failed double top. All multiples of bottoms and tops can fail. My tip is to keep an eye on volume as the pattern is being formed. Price will most likely break out in the direction of the heavier volume.
This pattern is also known as a trading range, a congestion area, and of course Charles Dow would simply call it a line. I'd like to apologise if I'm doing your head in by exploding the myth of cut and dried black and white continuation and reversal patterns, but take a look at this.
What we have before us is an inverse head and shoulders. We described this very recently as an unequivocal reversal pattern found at the bottom of the market. But take a look to the left of the pattern That's the recent past. What's going on here? The price is on an uptrend, and then Head and Shoulders kicked in as a correction, and then there's no reversal. What should a poor trader do?
Breathe easy, we're on familiar ground.
You know this pattern and its properties. There's the neckline. Price target will be head height at the minimum on breakout.
Sweet, what else could you wish for from life? As a trader, maybe a surefire thing, clairvoyance, but perhaps life would be too boring with such gifts.
Summing up, I reckon I can say with confidence that we've covered a lot of ground today. We've got to grips with reversal patterns, namely Head and Shoulders and its variations. We've introduced the fan principle, speed lines, and the wedge amongst others.
Whenever you meet these patterns, remember that they keep their promises, but don't expect more than they promise and don't see them when they're not there.
We've discussed how to identify and chart triangles, the pennant, the flag and rectangles. These are powerful trading skills. Also, don't forget volume. It's a vital consideration whenever you're working on the market. Throughout this film, I've tried to underline that there's no such thing as a sure thing. Remember, these patterns are only confirmed after breakout of the trigger line. Once again, never underestimate the market.
What we've covered today is not the be-all and end-all of charting by any means. Traders and analysts have been studying the markets for decades and they've unearthed many patterns. As a parting gift, let me leave you with what we in the chart room consider to be one of the sweetest.
Remember our work with channel lines in Chart Analysis 1, okay? Check this out. When price breaks out on a trend line, the correction will come to a halt either at Fibonacci level 0.382 or 0.5. We've got a little piece of the future in our hands right now. When the correction ends either here or here, the trend will continue anew for the length of the prior movement. Let me introduce the measured move, also known as the zigzag.
There you go, a thing of beauty is a joy forever. As I said before, we've covered a lot of ground in these last two films. These two DVDs will help you to go over the examples as many times as you would like, and you can use them alongside your exploration of Rumus's vast data banks. If you have any questions, please contact me on fxc@fxclub.com. I'll be glad to help you in any way I can. In our future films, we'll be taking a good look at Elliott's wave theory, uncovering the mysteries of Japanese candlesticks, and studying the history of some of the world's major currencies. See you again soon!